Hello, welcome back to part two of our discussion of retirement plans. We're looking at individual sponsored retirement plans, those that our employer is not involved in. So typically the two types, the traditional ones that we have as far as individual plans are the traditional IRA and the Roth IRA. Now both of them have some similarities. Okay, they're both limited to contributions of $6,000 per year, or 100% of your compensation. However, there is, like we talked earlier, an extra you can put in if you're over 50. So both of those limits, so 6,000 and 7,000, apply to both regular and Roth IRAs. Okay, so that. In that regard, they are the same. Now, these generally for IRAs are those who don't use them or those who don't have employer-sponsored plan. Typically, it's a better deal if your employer puts money in for you as well as you putting money in. So the IRA, it's entirely yourself. Okay, so if you have an employer plan and you decide you want to do a regular traditional IRA as well, you can do that, but you can only deduct the contribution. You get your maximum of 6,000 or 7,000, but it only becomes deductible if your income is not too high. Okay, so if you're married filing jointly and your AGI reaches 104, it starts to phase out. Not that you can't put your money into your IRA, but you can't deduct it. If your income is below 104, then you're good to go, even if you have an employer plan. Remember, this only applies to those who have an employer plan. And it phases out till you get to 124. So basically, if your income's anywhere in between, you're going to phase out part of the amount that you could put in, and meaning it would not be deductible. If you put money into a regular IRA that is non-deductible, it is referred to as a non-deductible IRA, and you have to keep track of that because that's going to affect the situation when you pull the money back out. Okay, 65,000 is lower if you're not married. Okay, and again, the phase out is only 10,000 range. Notice married filing separately. Another detriment for that filing status, the phase out starts at 0. Like I said, still make non-deductible contributions. Even if your income is over 124,000, you're married, you can still make a non-deductible contribution. But that would generally not be a good idea. You generally want to put that money into a Roth IRA, not into a regular IRA, non-deductible, because now you've got issues that regular IRA is partially deductible and partially non-deductible, and so that makes your record keeping much more difficult. Now, the issue with those that are married filing jointly, what if you're not sponsored, you don't have an employer plan, but your spouse does? Okay, if they're both employed and you're neither covered, you can make deductible IRAs just like anyone else, okay? 6,000 each or 7,000 if you're over 50. But it's the issue where one has an employer plan, okay? What's the deal? Now, if the other spouse has no income, then the rule allows that the one spouse that is working and has income can put in for both of them, as long as their income is more than that. So if their income is at least 12,000, they could put in the 6 for them and 6 for their spouse. If one of the spouses is working, has income, and is sponsored by an employer, okay, then the spouse that has no employer plan can still make contributions, and they're not affected by the limits on the last slide, but is affected by a new limit, and that is it starts at 196,000 of joint income, if you're over that, then it starts to phase out that even the spouse of someone who has an employer-sponsored plan has to be considered. Okay, so it's much higher, as you notice, but there's still a limit and still has to phase out. So if your income was $200,000, then and your spouse has an employer-sponsored plan, but you do not, and you want to make a contribution, part of it is going to be non-deductible if you make the full $6,000. Now you can put in just the amount that's deductible. That would be one way to get around that. If you figure out that you're phased out and only $4,000 deductible, and that's you only put $4,000 in, that works. That's how then you would still get the full deduction for what you put in. Now on the other side, Roth IRAs, relatively much newer than regular or traditional IRAs. Contributions are the same, but they're not deductible when you put them in. So you put money into a Roth IRA and it doesn't affect your income currently. And as we learned earlier, that means that there's the ability to pull it out without being taxable later. And that's true about a Roth IRA. However, you can't even put money in if your income is too high. There's your phase out starts. $196K for $106,000 for married filing jointly, $124 single and head of household, and $0 again for married filing separately. $10,000 for married filing jointly, $15,000 for the others for the phase out range. That say so if it's your income of married filing jointly over 206, then you cannot make a Roth IRA. If it's in between 196 to 206, you can put a partial. So if you're halfway down there, you can make half of the contribution. See, remember, there's no deduction for Roth IRA. It's just that you can't put it in at all. And if you do, there would be a penalty tax. So here's the trade-off. You decide, okay, should I make it traditional? Should I do Roth? Okay, do I want a deduction now? Or do I want to pull it out tax-free later? Either way, both sides, the interest inside the plan is going to grow tax-free. Okay? So there's your trade-off between the two plans. Traditional Roth IRA, if you're 58, make $30,000, you can make regardless of whether you sponsor a plan or not, because you're under the threshold, you can make a tax-deductible contribution of up to $7,000. You're over 50, right? So you get that extra $1,000. The $30,000 is not enough income to make start to phase out the deduction part of your IRA. Married couple who are not participants in an employer retirement plan with earned income of $200,000, that's a lot, right? But if they are not in a sponsored plan, they can still make an IRA contribution. Okay, so they are not ineligible or they are eligible. All right. And distributions from Roth IRA are generally not taxable. That is true. That is basically the premise. But remember, that means that the contributions are not deductible now. They do not change our taxable income currently. Now, closely related, as we mentioned earlier, to these Roth IRA and IRA rules are education savings accounts. These are accounts designed to save money not for retirement per se, but for paying for education. So the contributions are treated like a Roth IRA in that they're not deductible now. The amount grows tax-free, and the distributions are not taxable as long as you use them for what they're designed to. Okay? In this case, it is elementary, secondary, or higher education expenses of the beneficiary. Notice there's not a limit. This is a way you can do it for a non-relative. Back when we were talking about education credits, typically, if you pay for education expenses for a non-dependent, you're not going to get the benefit of that. The dependent is going to get the benefit of that tax issue. Here, you can set them up for anyone. So if you decide you have a really good friend and you want to set up a CSEA for them, you can and put the money in. Now, you don't get a deduction now, but then that money can be pulled out tax-free later on to pay for education expenses. And it was broad here, elementary, secondary, or higher education. But limit $2,000 per beneficiary. So you can set up an account for each of your 4 children and cousins and nieces and nephews, okay? But your contribution per beneficiary is $2,000. And again, if your income's too high, you're not allowed to put money in. Same way as a Roth IRA. Over $190,000, okay, goes up to $220,000 partially. If you're halfway in between there, you're going to be able to put half of it in. If you're under $190,000, you can put all $2,000. If you're over $220,000, you can't put it in at all. For married filing jointly, for those that are single, 95 up to 110. Now, probably a better plan now than the Coverdale accounts, the CSA plans, is qualified tuition plans. These are sponsored typically by states with the idea that you put money in and then it grows tax-free, and as long as you pull the money out to pay education expenses, then you don't pay taxes on it when you pull it out. Now, it's not deductible when you put in, but it doesn't have the $2,000 limit either, okay? And that's why the Coverdale accounts have become kind of obsolete, because these types of plans will actually allow you to do the same thing, but you don't have the limits. Okay, notice that there are qualified expenses that are limited, okay? Education institutions, computer, software, okay, and room and board are included. That's a broader definition than we use for qualified education expenses when we were talking about the American Opportunity Tax Credit or the tuition and fees deduction back in earlier chapters. Added in the law recently, 2017, up to $10,000 out of these qualified tuition plans can be used for K through 12, but only for tuition. All right. If you pull it out early or without using it for education, it's taxable income and subject to a 10% penalty on top of that. Now, what if you put money into a plan and the kid gets to college age and doesn't want to go to college? They join the military. They do something different. Okay, you can roll it over to another family member. All right, you can do the CSEA and Q2P the same year. You can put $5,000 in one and the $2,000 limit in the other. Okay, and you can pull money out of these plans and claim the credit. But here's the thing. Let's say that you pull $4,000 out of your qualified tuition plan and pay towards tuition. You cannot use that for the American Opportunity Credit. But if tuition was $8,000, you pulled $4,000 out of your qualified plan and you paid another $4,000 out of your pocket, you could use the other $4,000 you didn't pull out of the plan to qualify for the American Opportunity Credit. Okay? As long as you don't use the money twice, as long as there's enough, and tuition is usually high enough to use both. Okay? So contributions to Coverdale education savings accounts are not deductible. That is true. That means they don't reduce your income. Their maximum contribution is $2,000. All right, single taxpayer starts to phase out at 95. And computers, okay, are one of the listed things that qualify as to be used for money pulled out of a qualified tuition plan. All right, so qualified tuition plans have really become the best way to save for education expenses. So the idea of distributions. We've talked about that in general. If distributions are taxable, if contributions were deductible, meaning if you save money now, you have to pay it later. Now, there may be some things that get mixed up in there. There may be some non-deductible, deductible in the same account, that sort of thing. Then we have issue when we pull it out. Part of it could be taxable and part of it not. All right. The simplified method basically says how much do we have in the plan that was put in after tax, meaning we didn't save money on it when we put it in. From previously taxed dollars, you take that amount, you divide it by the number of payments. And the number of payments is dependent on the age, okay? And you can see that in a textbook. And that amount is not included in taxes, okay? That's not taxable income. And when you regular IRAs, 401k, that sort of plans, they require you to start taking out money. Okay, you must do a required minimum distribution by April 1st of the following year after you reach 70.5 is the old rule. For 2020, it went up to 72. So once you turn 72, you have to start taking money out. You can't just lay it in, even if you don't need it to live on. Okay, if you're living on Social Security, you're living on other income, you're still working, for instance, at age 72, you still have to pull money out of your 401k and pay taxes on it. Okay, it's based on life expectancy from the IRS normally, table 3. Okay. That's what the IRS uses to determine the life expectancy each year. Because of COVID, 2020, required minimum distributions were not required. So you didn't have to pull money out for 2020. Roth IRA distributions, on the other hand, are generally not taxable, even if they're taken early, even if they're taken prior retirement, as long as you leave them in there at least 5 years. And then only the earnings, how much interest you earn. So that kind of, the rule is that the earnings should not be taxable, but when you pull out early before retirement, that might happen. They may be earned, but only the earnings part. And you're always assumed to pull out what you put in first. And again, the savings account for education savings account are tax-free if you used to pay for qualified. It's what you spend it on. Now there are penalties for premature, before 59.5 is typically considered a premature distribution. And they are subject to a 10% penalty. Okay, but the tax law has added a whole bunch of exceptions to that. All right, and you see them on page 1119. And they've added, even for this 2020, for those that are COVID related, but the list gets longer, seems like every year, exceptions to this, which means that while they may still be taxable income, they will not charge a penalty. Okay? Rollovers are generally tax-free, meaning if you pull it out from one trustee and give it to another trustee, then the idea, that's a rollover. That shouldn't be taxable. Just because you decided to use Fidelity instead of a different, Charles Schwab for your trustee, you move it from one to another, that's not a taxable event. Okay? Even if you pull it out and say, oh, I changed my mind, you have 60 days to put it back in and it not be taxable. So you pull it out and think, oh, I'm going to do something crazy, and then you say, that was a dumb idea, and you put it back in. You're good to go as long as 60 days. Not a good idea one way or another. You're still going to have to, the IRS is going to see that as an issue, and you're going to have to make sure you can prove that you put it back in within that 60 days. Okay? Distributions, a participant in check defined benefit plan is only entitled to only a stream of payment. That's true. Distributions from a qualified pension could be taxable, non-taxable, or a mix of both, right? We have ways, if you mixed in non-deductible and deductible contributions, then when you pull it out, you've got a mix as well. All right? From your textbook, the number of anticipated payments from a pension plan for a single individual age 68 is 210. And the number of anticipated pension payments if you're between 59 and 63 is 310. Okay, and again, just moving down that table that's given in the text, and distributions are required from a traditional IRA. Remember, moved from 70.5 to 72 in 2020, but they are still required.